Most investors treat earnings like a coin toss. They buy a stock or an option for the announcement, hope the company beats expectations, and then wait to see what happens. That is not a trading strategy. It is gambling on information you do not have. Hi, this is Steve from Market Edge Australia. In this video, I'm going to explain how I approach U.S. earnings season without taking unnecessary binary risk. The first thing to understand is that a company beating its earnings estimate does not automatically mean the share price will rise. The market is not simply asking whether a company made more money than analysts expected. It is asking whether the result was better or worse than what was already priced into the stock. A company can beat both revenue and earnings estimates and still fall 10%. Why? Because investors expected an even stronger result. Management lowered its guidance, margins deteriorated, or the share price had already rallied heavily before the announcement. The headline number is only one part of the story. That is why I generally avoid putting on a large directional position immediately before earnings. Even when you correctly predict the result, you can still lose money. This is particularly true with options. Before major earnings announcement, implied volatility is normally elevated. Options become expensive because the market expects a large move. Once the result is released, the uncertainty disappears and implied volatility can collapse. This is known as volatility crush. You can buy a call, correctly predict the stock will rise, and still make very little or even lose money because you paid too much for the option before the announcement. Instead of gambling on the result, I prefer to let the company report and then examine the market's reaction. There are several things I'm looking for. First, did the company beat or miss expectation? Second, what did management say about the next quarter and the remainder of the year? Third, did the company raise or lower its guidance? Fourth, how did the stock initially react, and did the reaction hold during the regular trading session? Finally, what happened to other companies in the same industry? That last point is particularly important. A major earnings result rarely affects only one company. If a semiconductor company reports unexpectedly strong demand, other semiconductor stocks may move with it. If a major bank reports rising credit losses, the weakness can spread across the banking sector. These are known as sympathy trades, and they can sometimes offer a cleaner opportunity than trading the company that actually reported. I also pay close attention to the second trading day after the announcement. On the first day, the stock is absorbing analyst upgrades, institutional orders, short covering, and large amounts of emotional trading. By the second day, the market often gives a clearer indication of whether the move is genuine or whether the initial reaction was excessive. If the stock holds its earnings gap, remains above its volume-weighted average price, and continues attracting buyers, that can indicate that institutions are still building positions. If the initial move completely reverses, that tells us something different. The objective is not to catch every dollar of the move. The objective is to trade after we have more information and can define the risk properly. Depending on the setup, that may involve buying the shares using a defined risk credit spread or using a calendar spread where the position benefits from time decay. But the structure comes after the analysis. You should never select option strategies first and then go looking for a reason to use it. Start with the company, the result, the guidance, the price reaction, and the sector. Then decide whether there is a trade. Earnings season creates some of the best trading opportunities in the U.S. market, but you do not need to gamble on the announcement itself. Let other traders take the binary risk. Once the result is public and the market begins revealing its hand, that is when the more disciplined opportunities appear. This is Steve from Market Edge Australia.